Well, I don't think there's a particular risk in the economy over time. We will have recessions from time to time. And we had a real doozy in the fall of 2008 and early 2009. And that has had more consequences than other recessions have had post-World War II. But the American economy is a wonderful machine. It really works. It's worked since 1776, and it'll continue to work. But we will continue to have ups and downs.
Recession is coming, but you can use it to get rich by following the steps in this video. If you are ready, let's dive into it. There is no doubt that next year will be one of the most challenging years economically due to rising global inflation, and the crisis in the Middle East has made things more gloomy. However, you can leverage the situation to become wealthy instead of poor. In today's video, we will listen to the insights of renowned investor and business mogul Warren Buffett. The Oracle of Omaha will explain how to use the recession to your advantage in the coming year. Keep cash reserves. Buffett believes cash is like oxygen for any business because it keeps them alive, especially during economic turbulence. When a recession hits, it becomes much harder to generate revenue or access capital. Companies with insufficient cash reserves can find themselves in precarious situations, forcing them to make tough choices, such as laying off workers or closing the operations entirely. Cash also plays a crucial role in individuals' personal finances. During a recession, job security can become uncertain, and economic hardship can impact personal income sources.
If you're working in something where you're living off your paycheck from week to week, you want to have a little cash around, and you certainly don't want to have a credit card that's maxed out or anything like that.
Therefore, you need to maintain sufficient cash reserves to provide for yourself. By maintaining adequate cash reserves, you can give yourself a safety net to cover your essential expenses, handle emergencies, and avoid stressful situations like mounting debt or financial insecurity. Moreover, cash reserves provide opportunities to take advantage of investment opportunities that may arise during a recession when assets can be acquired at favorable prices. But what would be an appropriate amount for individuals to maintain as cash reserves during a recession? The ideal amount varies based on individual circumstances such as monthly expenses, dependents, job stability, and overall financial health. However, a general rule of thumb is to have a minimum of 3 to 6 months' worth of living expenses covered by cash reserves. There are several strategies to accomplish this step. Firstly, individuals should adopt a disciplined approach towards saving and budgeting, ensuring that a portion of their income is consistently allocated towards building cash reserves. Redirecting unnecessary expenses and prioritizing long-term financial security can go a long way. Secondly, individuals should carefully manage debt, avoiding unnecessary borrowing and working towards reducing existing debt burdens. This not only frees up cash flow, but also minimizes financial vulnerability during a recession. Educate yourself. Buffett's success stems from continuous learning. Educate yourself on financial markets, various investment strategies, and economic indicators to make informed decisions. As we all know, recessions can be tough times for individuals and economies. However, they also serve as opportunities for personal growth and development. By keeping yourself updated on financial matters, you can navigate through uncertain times, identify potential risks, and position yourself advantageously to avoid the worst consequences of a recession. Additionally, investing in your own knowledge can provide you with a competitive advantage. When economic uncertainties arise, industries tend to change rapidly. Through the process, you will stay informed about new technologies, market trends, and economic principles, and you can position yourself ahead of the curve. As Warren Buffett said, the more you learn, the more you earn. Secondly, expanding your knowledge base equips you with better decision-making skills. During recessions, making sound financial choices becomes even more trivial. By educating yourself, you can acquire the necessary tools to assess risk, uncover potential opportunities, and make informed decisions while others panic. Buffett once stated, "Risk comes from not knowing what you're doing." Further, Continuous learning allows you to adapt and discover alternative income streams. During economic downturns, some industries may suffer more than others. By expanding your skill set and knowledge, you can pivot into areas that are less affected, increasing your chances of maintaining financial stability. Warren Buffett advises, invest in yourself as much as possible. You are your biggest asset. Knowing the importance of educating yourself, let's discuss practical ways to accomplish this step. First, you need to read books. Warren Buffett attributes his success to reading. Pick up books on finance, economics, entrepreneurship, and personal development to gain insights from experts. Also, attending webinars or online courses helps. Take advantage of the digital age and enroll in relevant webinars or online courses. Many esteemed institutions offer accessible or affordable programs to help you gain new skills and knowledge. Avoid excessive debt. During recessions, credit markets often tighten, making it harder to repay debts. Buffett advises minimizing debt and keeping a tight grip on your financial obligations. By managing your debt responsibly, you can protect yourself from financial strain during economic downturns and avoid potential defaults. According to Warren Buffett, accumulating a high level of debt can be perilous. During a recession, individuals and businesses may face income challenges or reduced earning potential. If you have extensive debts, your ability to weather financial storms becomes significantly compromised. Buffett encourages us to be cautious about borrowing more than we can handle. But how do you avoid excessive debt? Begin by evaluating your current debt situation thoroughly. Calculate your outstanding debts, interest rates, and repayment terms to gain a clear understanding of your obligations. Then, prioritize your debt payments. Focus on high-interest debts as they can quickly escalate and become burdensome. Make extra payments toward these debts and gradually work towards eliminating them. The next step is budgeting and adjusting your lifestyle. Creating and sticking to a budget is vital for managing and reducing debt. Identify areas where you can reduce expenses and redirect those savings towards debt payments. Also, if you struggle with managing your debts, don't hesitate to seek guidance from financial experts or credit counselors. They can help you create a customized plan based on your specific circumstances. Overall, Buffett suggests that during a recession, opportunities tend to arise for long-term investors who have cash on hand. By remaining debt-free, you enable yourself to seize investment opportunities that can yield substantial returns. Maintain a long-term investment outlook.
But you shouldn't buy stocks unless you expect to hold them for a very extended period and you are prepared financially and psychologically to hold them the same way you would hold a farm and never look at a quote. You don't need to pay attention to them. And you're not going to pick the bottom and nobody else can pick it for you or anything of the sort. You've got to be prepared to, when you buy a stock, to have it go down 50% or more.
Warren Buffett advocates for a patient and long-term investment approach. Avoid succumbing to short-term market fluctuations driven by uncertainty. Instead, focus on the long-term growth potential of your investments. This mindset will help you ride out the recessionary waves and capitalize on future market recoveries. He urges investors to view recessions as opportunities rather than obstacles, keeping their eyes on the horizon instead of getting swayed by short-lived market panics. Warren Buffett once said, "Our favorite holding period is forever."
Anytime stocks go down, as far as I'm concerned, I like it because I'm a net buyer of stocks. I've been buying stocks ever since I was 11 years old. So when stocks go down, it's good news. Just like when hamburgers go down, it's good news, or Coca-Cola goes down, it's good news. It turns.
So, investors should be contrarian and take advantage of recession-induced pessimism and fear in the market, which will help them invest with a long-term perspective. By maintaining a long-term perspective, Buffett believes investors can spot great deals and accumulate well-established companies at discount prices. Buffett substantiates his investment philosophy by highlighting his own long-term success. His charts showcases the steady compound returns he has achieved through maintaining a long-term investment outlook, even during recessions. For example, among Buffett's famous recession investments are the Coca-Cola Company during the 1980s and his first purchase of American Express stocks after the stock market crash in 1987. These stories highlight his confidence in long-term value and the rewards it can bring during tough economic times. But how can you decide on the right company to invest in the long term? One of the best ways to determine the potential of a company is to consider its comparative advantage. Buffett believes that companies with a strong economic moat can weather economic downturns better than others. By investing in such companies during recessions, investors position themselves for long-term growth once the economy recovers. Invest in the stock market.
I can't predict recessions. If you guaranteed me there would be a recession next year, I would be buying and selling the same securities I'm buying and selling today.
Warren Buffett is widely regarded as one of the greatest investors ever. One of the core principles Warren Buffett follows is to invest in companies with a competitive advantage. Therefore, you have to watch for consistent cash flow, debts, and overall financial strength of the corporation. These indices will give you a vivid picture of the financial state of their operations. He looks for businesses with unique products or services, strong brand recognition, and a dominant market position. Companies with a sustainable competitive advantage tend to generate consistent profits over the long term. In the coming year, you need to consider businesses with a proven track record of success, as they are more likely to survive the recession. It would help if you also were a firm believer in the power of compounding. Instead of trying to time the market or chase short-term gains, Buffett suggests staying invested in quality companies for an extended period. This approach allows investors to benefit from the growth and compounding of their investments. Another factor to consider before investing in the stock market is staying within your circle of competence. It would be best for you to invest in industries and companies you understand well. By doing thorough research and analysis, you can make informed investment decisions based on your knowledge and expertise. Further, Buffett is known for his value investing approach. He seeks out undervalued companies or trading at a discount to their intrinsic value, and you can copy this step to purchase stocks at a lower price. Also, your stock value will increase when the market recognizes the true value of the company. Finally, diversification without over-diversifying your investment. Buffett recommends diversifying an investment portfolio to minimize risk. However, he also cautions against over-diversification. It is important to balance spreading your investments across different asset classes and concentrating investments in high-confidence opportunities. Also, embracing contrarian investing will help you in the stock market and enable you to gain from the recession rather than suffer financially during the period. Warren Buffett has always been a contrarian investor, advocating for buying when others are fearful. During recessions, markets often experience panic selling, creating buying opportunities for long-term investors. Be mindful of market sentiment and consider investing in quality assets undervalued due to short-term market turbulence. Learn from mistakes. We all know that economic recessions can have a significant impact on our financial well-being. However, by learning from mistakes, we can better prepare ourselves to navigate these challenging times. How can you learn from past mistakes? Let's learn how. First, you need to analyze the mistakes of the past. By studying what went wrong in previous downturns, we can identify patterns and potential warning signs for economic trouble. For example, the Great Recession of 2008 saw many financial institutions overextend themselves, take excessive risks, and fail to manage their investments adequately. These actions ultimately led to the collapse of the housing market and triggered a global financial crisis. By studying these mistakes, we can recognize signs of over-leveraging and avoid similar pitfalls. Secondly, you need to adapt to changing market conditions. Markets are dynamic and constantly evolving. By monitoring economic trends and being open to adapting our financial strategies, we can better position ourselves to weather potential recessionary storms. By implementing these strategies inspired by Warren Buffett, you can increase the likelihood of shielding your finances from a recession and use it to get rich in 2024. If you found this video helpful, please hit the like button, subscribe to our channel, and don't forget to turn on the notification bell to stay updated with our latest content.